yellow lights don't turn green. There are several meanings. As you said, there are times where you are looking at something and you know in your heart of hearts that there's a bump in the road, and you might over explain it, or you might get your, escalation of commitment is a real problem in the investment business. I'd spent 6 months on this thing. We got everybody working on it, and you find some damning information and you kind of look the other way because it's not totally damning. It's only a little bit damning. And, and you're dug in and you think this deal's going to get through investment committee. And so you don't want to, again, back to the culture, you want to create a culture where somebody is rewarded for saying, time out. I've been the champion, but I'm changing my mind. If you can do that in the investment business, you win. But that to me is to appreciate that yellow lights don't turn green. When I look at our mistakes and reverse engineer them, I kick myself. I say, you know what? We saw that. And had we acted on that, it was a small little problem and we could have dealt with it before it became a big cancer. And that happens with people. People are in the wrong spot. People, maybe it's not a good fit. But you can just tell with people, and you'll see people say, I'm going to get them coached, and you sit there and say, you know what, maybe if you deal with a personnel issue early, most of them are totally, correctable and fixable and whatever, and overcomeable. But if you wait too long, then you're like, oh my God, I got the wrong person in the wrong spot, and now I'm in trouble. So from a personal standpoint, that's what yellow lights don't turn green. From a business standpoint, it's about intellectual honesty and trying to avoid very, very well documented biases, groupthink, escalation commitment, recency bias, selection bias. I mean, human beings are terrible decision makers. I mean, it's amazing that the world even functions like it does. There are wonderful books written by the sociology departments around this and the assessment of risk. And people don't assess risk very well. So here I show up as a total generalist. I just said, well, this shouldn't be so hard. Anyway, not that I don't want to trivialize it. It's not that we didn't do, modeling and everything else. But if I were to break it down really simply, it's that people assess risk deterministically when it's really probabilistic. And they'll do a discounted cash flow analysis and say the value of this business is 122.3572. You know what? I'll tell you it's not. I don't know if it's over or under. I'll take the difference. Mm-hmm. It may be higher. It may be lower. The odds of it being that number is rounds to zero. Okay? But what you're doing is you're taking a stab probabilistically saying, well, in this range of discount rates, in this range of growth rates, and this range of terminal values. Well, in a terminal value calculation, there's an implicit interest rate assumption, which has an implicit read on the future of the economy at that moment in time. So if you're selling the business in year 10, there's going to be, and you stick a terminal value interest rate on it, or terminal value that has an implicit interest rate in it, which has an implicit read on what is happening in the world economy from years 11 to years 20. Well, if you can predict that, you're in the wrong business. So to me, that the way I always looked at things was probabilistically, like, what's the risk reward ratio? I mean, how could we lose all our money? If we could lose all our money, then we better have a really good return, like really, really, really good return. But if on all these different scenarios, we'll get back 90 cents, we'll get back 80 cents. Well, that sounds bad. What if I told you you're risking a dime? You're putting in $1, you're risking a dime. But you might make $2. Okay, so I'm risking 10 cents to make $1.90. That's not a bad risk reward. Now I say, well, what are the chances? And we spend all our time talking probabilistically around the scenarios. And that, to me, it creates an air of debate, of discussion, and it gets people less dug in because there's a little more humility in that than saying, oh, I ran the discounted cash flows. It's worth $123,270,000, like whatever.
So what I'm hearing is be aware of the spreadsheet heroes.
Yes.
The people that are just like stuck to that spreadsheet, because if I'm hearing correctly, they're the ones that are like dug in on that. Hey, they're deterministic and it's going to be this.
You can do the spreadsheets, but then I always ask, what does it mean to you?
Right.
And that develops that muscle, which is explaining it and say, well, what if I change one of your assumptions? Instead of saying, oh, no, that'll never happen, I said, no, do me a favor, just change it. And now let's look at the outcome.